Let's start looking at the new subject, which is the derivatives. Again, having a 5% weightage from your level 1. And concept wise, probably a very relatively new concept, only hardly 20-25 years old kind of a concept, wherein the major thing that we are trying to look at in derivatives is the buying or selling of an asset will happen at a future date, not today, but the agreement for that will happen today. That is what is a difference between a typical buying and selling or a spot market kind of a transaction versus a derivative market kind of a transaction. Whenever we talk about the word derivatives market, the whole buying and selling will happen at some future date. There are so many, there are four types of derivatives that are available, but all four of them have this commonality. The buying and selling will happen at a future date. It could be even tomorrow also, or it could be after 1 year also. But the buying and selling will happen at a future date, but the agreement, like at what price we will buy, or how much quantity we will buy, or how much, what quality we will buy, where should you buy, where should you sell, all these kind of things about the quality, quantity, price, everything is agreed upon today. That kind of a transaction is called a derivative. It's almost as good as advance bookings, right? Probably the I really want to buy something after 1 month, but I will book it today itself. Probably there is a kind of scenario that was existing even for some kind of cars or something, where you 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 book the car today itself, but the car may come after 2 months. So, I mean, there even see here the scenario is very clear that the date on which you are going to get into a buy sell transaction is known in advance, and the price of it is also decided today itself. But the only thing is, then it is purely based on how you expect that the price will go in future. See, let's say we are talking about a commodity. Let's say we talk about a commodity like wheat or something like this. Today, the price of it is some $1,000, right? But I don't want wheat now. I want wheat after 1 month, right? I want wheat after 1 month. So probably this, in the simplest sense, what we may very well do. But if I visualize that, I mean, there is a possibility that wheat may go to 1200 after 1 month, right? What I can simply try doing is I will get into an agreement with my shopkeeper. I'm giving a very simple scenario. I'll get into a kind of an agreement with the shopkeeper saying after 1 month I'll buy this much of wheat from you. Probably you should give me at 1050. But today I'll not buy it at 1000 because I don't need it today. If I buy it also, I may have to store it somewhere. I may have to protect it. Lot of other issues because I don't need it, or probably I may not be having cash also. So because of various reasons, I don't want to buy it today. But at the same time, I visualize that the price may touch 1200 after 1 month because of various reasons that are attributable. And based on that, I want to get into an agreement saying that at that point in time, I will buy it at only 1050 from you. And if the shopkeeper is also fine with it, shopkeeper may also feel, yeah, someone is there who is ready to buy my product. If he doesn't think that it will go to 1200, if he is of the opinion, oh, then it's a good deal. Probably if I sell it to someone today, I have to sell it at 1000 only, but this guy is ready to buy it at 1050 from me after 1 month. So let me stock it for one more month, and after that I can sell it to him. So There could be some kind of advantage to both the parties, right? But if it really, we don't know what is the real price after 1 month. If it really touches 1200, then probably the buyer was at a benefit because he bought it at 1050 only. If it had gone to 900 only, then probably seller would have been at a benefit because he sold it at 1050. The agreement was made today itself. 30 days back, the agreement was made about the price. That is the whole derivatives market transaction. So today, they are ruling the world, wherein even the mechanism got extended slightly more further, not just to commodities like this, it got extended to almost every security, wherein the deal will happen in future. So to generalize it, it became very simplified today. The deal will actually happen in future. The real buy sell operation. It could be equity, it could be a bond, it could be a real estate, it could be anything else. The buying and selling will happen in future, but the deal is going to happen today. The agreement is going to happen today. That's the reason the derivatives are called as either contracts or agreement. They don't have a independent existence. They are always dependent on some other asset, because the deal is always to buy or sell some asset in future. So based on how you visualize the price of that asset in future, the derivative trading will go accordingly. So that's where, as a simple statement, also people use derivative as a value that is derived from the value of another asset. So, because the asset is really bought or sold kind of an instrument. It could be a commodity, it could be a bond, it could be any financial asset, it could be a consumption asset, any of them. It could be gold, it could be a stock, it could be bonds, it could be a mutual fund, anything. In all of them, wherever we are thinking that the buying and selling happens at a future date, or it could be even extended to the concept of interest rate. I'll take a loan after 1 month or after 6 months. Let's fix the interest rate at 8%. I may get into an agreement with the bank saying I'll take a loan for 20 years, but I don't want it now. I'll take it after 6 months, right? So we'll fix the deal at 8% per year. So if the interest rate after 6 months is actually 8.5%, then probably borrower is at an advantage because he is borrowing it at 8% only. If the interest rates go to 7.5%, then the lender is at an advantage, or the bank is at an advantage because it's able to lend at 8% to this person. So that is what is the whole world of derivatives transaction. Out of these, some of these derivatives are traded on some exchanges. We have exchanges like NCDEX or MCX or even NSE. All these exchanges, they deal with derivatives transactions. Even BSE deals with derivatives transactions apart from stocks. Whereas some kind of derivatives are traded purely over the counter. Over the counter are more like two-party based transactions between you and me. Like the earlier example I was talking of, shopkeeper and a person. It can happen in millions of dollars contracts also, probably not just a few thousands or something. Even that deal can go to the extent of millions of dollars also. So, yeah, there are four major tools or four major derivative instruments which we generally discuss about. We call them as forwards, futures, options, and swaps. All four of them have a commonality, which is the buying and selling happen at a future date, and the price is decided today. That is the commonality across all the four. But out of these four, these two are always traded on the over the counter market, which is always between two parties, forwards and swaps. Whereas futures is always on the exchange. And options is the most interesting instrument of all. Some of the options are traded on exchange, some of them are traded on over the counter. And wherever they are traded over the counter, whichever instrument is traded over the counter, they are highly customizable because it's just a deal between two parties. So we can negotiate the terms of the contract. So we use the word saying they are all highly customizable, right? Or I mean the price, quantity, quality, everything we can fix up. And but they are not liquid because let's say both of us have got into a contract. If I want to exit out of the contract, there is no other mechanism for me. It's very difficult for me to exit because I have to link you to someone else. Only or my side has to be taken by someone else. Only then I can exit out of the contract. So whereas when we are talking about exchange traded contracts, they will not be customizable at all because exchange, like stock, the stock price is one which is there on the price is there on the exchange, and exchange will deal with only certain type of commodity. Not all commodities exchange will take up because the main reason why we are talking of exchange is it's a centralized marketplace, right? And we have also discussed in equities, the clearing house of an exchange will always take the side of the counterparty. It makes sure that the buyer is not known to the seller, seller is not known to the buyer. So because of that, here the risk is with respect to the exchange, right? If there is a buyer but there is no seller, exchange has to become the seller, and so it sells. If it has to sell, then probably it has to buy from somewhere and it has to sell. And if there is no seller, exchange will have an issue. Exchange will have to take a big risk. So because of that reason, exchange deals with only those kind of commodities or assets which have a very high demand. So probably as a simple example, let's say there are 100 types of oils available. We talk about 100 types of oils, right? Different, probably you can talk about sunflower oil, corn oil, palm olive oil, I don't know what all kinds of groundnut oil, rice bran oil, so many oils are there. Castor oil, olive oil. So probably now there will be buyers and sellers for all of them, right? So if at all I want to buy some big bulk of that oil, probably I can get into a contract with a shopkeeper saying, yeah, I'll not buy it today, but after 1 month or probably every month I'll buy these many liters of oil from you. Shall we fix up a price for the next 1 year? So some kind of an agreement we can get it. Whereas the same thing if it is happening over an exchange thinks, oh, is the frequency of buyers and sellers very high for this product? Because from an exchange standpoint, if there is a huge buy request, exchange has to sell it. And if there is a exchange, if exchange has to sell it, exchange is not a oil dealer. So it has to buy oil from someone else, right? So there should be some other seller who is there who should be able to, who says, I will sell my oil onto the exchange. Then exchange has to buy from him and then sell it to the buyer. But if it finds that, oh, these many transactions are not possible, it will not deal those kind of products. Let's say olive oil, it does not want to deal with the olive oil product at all. Now, if that's the case, where can olive oil be traded? Only on a over the counter market itself, because not too many contracts are there and exchange has not taken up that particular product, which means exchange always goes with standardized and regulated kind of products. No customizable contracts. Probably there also it will say multiples of 5 liters only or multiples of 100 liters only you can trade. If you want 20 liters of oil, no, no way. Because the trade has to be in the multiples of 100 liters only, no odd lots. So some kind of these kind of issues. But the biggest thing is in case of over the counter contracts, the default risk is very high. What is the default risk? Probably we both are getting into a contract agreement. Either I may back out or you may back out. Right? That is what we are calling as default risk. Because it's not. There are so many instances where I may say no, I cannot buy it from you today, or you may say I cannot sell it to you today. So we have got into an agreement. We try to find some kind of loopholes, and each one can back out. And because of that, what could happen is generally the party who is losing will generally back out, right? So probably we have both got into an agreement saying I will buy wheat from you at $1,000 after 1 month. After 1 month, if the price of wheat has gone to 1100, I am ready to buy it at 1000 from you, but you may not be ready to sell it at 1000 for me. So you will try to find some kind of a loophole, because if you want to sell it into the market, you can sell it at 1100 today. So you may think of defaulting. So that is what we are saying. The default risk is very high in case of over-the-counter contracts, unless both the parties are very reliable parties. It's not advised to get into these kind of over-the-counter derivative contracts. Whereas in case of exchange traded contracts, the scope of a default risk is much lesser, because exchange is there as an intermediary, and exchange actually puts some kind of restrictions both on the buyer as well as the seller. That is what we say. Exchange gets into a risk management process by charging what is called as a margin. We'll discuss about this margin concept of futures. We have discussed margin trading as a part of equity, but there is a slight difference connotation of the word margin with respect to the derivatives contract, wherein exchange uses this margin as a kind of mechanism against the default risk, to make sure that none of the parties are defaulting. It will impose some kind of margin restrictions, and it will protect itself from any kind of a default risk. So that's where we say it's free from default risk. Whereas in case of over the counter derivatives contracts, they are very much prone to default risk. So as I said, these are the 4 types of derivative contracts that are there. Simple logic is, see, the whatever we have been talking of, between two parties, one party saying that I will buy something from you, the other party saying agreeing to I'll sell something to you at a future date, right? As an agreement between both the parties, no exchange, nothing. It's an agreement. If an agreement is happening between two parties over the counter, saying I'll buy something from you, I'll sell something to you at a future date. Date is also decided, price is also decided. Those kind of contracts, we call them as forward contracts. So key things, between both parties, no exchange in the middle. So which means they are all customizable kind of contracts. Default risk is very high. So those go into the forward contracts kind of category. So both the parties are obligated as per the contract. I have to buy from you on that day. You have to sell to me on that day. If one of the two is not happening, we call it as default. Then the same transaction, if it happens over an exchange, because there is a default risk in case of forward contract. So to avoid the default risk, if the same transaction happens over a standard exchange, we call it as a futures contract. Major difference between forward and futures being all forwards, whatever are getting traded, they are between the two parties, they are customizable, all that they are over the counter kind of transactions. Whereas all future contracts, again, buying and selling the same securities or assets at a future date, but over an exchange only. And the main advantage of getting into a future over a forward is reducing the default risk, because exchange will use some kind of a mechanism to reduce the default risk. So the major benefit of getting into a future contract over a forward contract is to avoid the default risk. But at the same time, there is a problem, because exchange may not trade in all the assets, and there are restrictions in terms of the quantity, standardized quantities, right? And even the dates, settlement dates, there are every restriction to everything. So because of that, futures have some limitations, but when all of them are working out, futures are better than the forward because they reduce the default risk. Then the third set of derivatives, which are the swaps, they are also more like forwards, but you can treat them as a series of forwards. See, forward, as we said, it is an agreement to buy and sell in future at a price which we are deciding today. Generally, it's a one-time activity. I'll buy some I'll buy some wheat from you. After 1 year, we are deciding after 1 month. Let's decide the price today. So after 1 month, that forward is over. The forward contract is either is executed. But when it comes to swaps, the agreement is done once, but transactions happen more than once. Probably I may say I'll get into an agreement for 2 years, wherein the transactions happen every quarter. So the deciding of the price, the deciding of the deal happens today for a 2 year period or something, but the transactions happen every quarter. So for all 8 transactions, the deal is fixed upon today itself. Those are what are called as swaps. So typically, in simple sense, you can understand swap as a series of forward contracts. But the only difference is, in a forward contract, you can think of getting into a contract for commodities, for stocks, for bonds, etc. Whereas in swaps, generally it is for cash flows. So both the parties exchange cash only. Like, probably I may say, I'll pay you some fixed rate on some amount. You pay me the floating rate on that amount. Or I'll pay you in dollars. You pay me in rupees. Both of the parties are paying cash only. Whereas in case of commodities, as I said, I'll pay you 1,000, you give me the wheat. Even that kind of deals could be there as a part of forward contracts. Whereas in case of swap contracts, they are purely based on cash flows, like generally interest rates, currencies, or the return on equities and commodities, right? And finally, when I am talking about options, the fourth kind of a product, the interesting aspect here is there is an option for one of the two parties to back out. So probably it's as good as like this: a buyer and a seller. Let's say we'll talk about A wants to buy something from B after 1 month, right? A is a buyer, B is a seller of some good. Probably we'll talk about oil. A wants to buy oil from B after 1 month, probably at $1,000. This is the deal. But So if it is a plain over the counter, we call it as forward. If the same deal happens over the exchange, we call it as future, right? In both forward, future, and of course, swap cannot be applicable on this, right? Swap can be applicable on the oil price differences. It's as a cash flow. I'll pay you the increase in the oil price, you pay me some fixed amount, right? Every quarter, whatever the oil, or every month, whatever the oil price difference that is there, I'll pay you that much, you pay me some constant fixed amount. Like that, I can get into a swap. Whereas when it comes to option, what happens is, in all these three contracts, both the parties have an obligation to adhere to the contract, right? A buyer has to buy, the seller has to sell. But when it comes to option, see, out of these two parties, one of them can take an option. Either this person can take an option or this person can take an option. When an option is taken by this person, so when we are talking about the option taken by the buyer of the original security or the seller of the original security. If the buyer of the original security takes the option, we call it as a call option. If this person takes an option, we call it as a put option. Now, on any transaction, only one person can take an option. In any one single transaction, only one person can take an option. Now, let's say this person has taken an option. What he has to do when he is saying I'll take an option, he will have to pay some premium to this person today itself. Though the deal will happen after 1 month, this party has to pay some premium just to exercise that option. What is that option? If you want, if I want, I will buy, otherwise I will not buy. It's not an obligation anymore for a person who has taken an option. So just to convince the other party about that option, today he is paying some premium to the other party. Non-refundable, non-adjustable. What I am saying non-refundable is, of course, even if you say I will not buy, after 1 month, that premium is lost. Second, if you are ready to buy also, you have to buy at the price which has, you have to buy at 1000, and that 20 or something, if you have paid a 50 as a premium, that, so you are overall paying 1050, not 1000. It's not adjusted with your 50. It's like a gone amount. Today you are paying 50 to the other party just to take a benefit, just it will help you to take a decision after 1 month. See, it's not obligated that you have to buy it. Let's say on that day the oil price goes to 1100 after 1 month. He is ready to buy it at 1000 because overall it has costed him only 1050. Right? So he is ready to buy it at 1000 and he will get a profit of 50 bucks. But if the oil price has gone to, let's say, 950, why should I buy it from you at 1000? I'll buy it in the market at 950. So I have lost only 50 bucks. I have already given 50 bucks to you as a premium. So I'll lose that 50 bucks. So that is how the option contract is dealt. Similarly, even if this guy has taken a put option, he will pay a premium to this person. Right? Again, what should that premium say? If I want, I will sell it to you, otherwise I will not sell it. Right? If he sells, this person has to buy. Mandatory. It's just like probably I am giving a token advance to my new house owner. I am a tenant. Let's say I am giving some kind of a token advance to my house owner. The intention of the token advance is, yeah, I'll come and join you at a later date, right? But and you have to give that house to me. You should not give it to anyone else. But probably, so the seller cannot back out. The owner cannot back out from that contract because he has received the token advance, right? He cannot rent the house to anyone else. But let's say if I don't want to get into that house, I have found some other better house, and I don't want to get into that house. If I forego that money, no issues. So that is what is more or less the concept of a premium in case of an option, because there the transaction wise one party has paid money to the other party on the beginning of the contract itself, whereas in none of the three contracts party X will pay any money to party Y today, because the deal happens only after 1 month or something. It's only an agreement today. No party is paying any money to the other party in forward, futures or swaps. Only in case of options, one party will pay some fixed money, some defined money to the other party on day zero itself, and that money payment is happening just to give a kind of an advantage to one of the two parties to decide whether they want to get into the contract on that last day or on at a future date, whether they want to get into the contract or get out of the contract. Even if they get out of the contract, the other party cannot do anything there. It's not considered as a default because the other party has been compensated with a premium to allow this person decide whether he wants to enter into the contract or let the contract expire. Getting it? So more and more details of these options and all the four contracts. We have four different chapters for four different types of contracts. So we'll have a bit of more and more understanding as we move along there. So typically derivatives wise today, though they are typically used, I mean on a positive note, derivatives are one of the powerful tools in the risk management industry today. They can mitigate lots and lots of your risk, because you can see when you think that the prices are going to go up, you can try to buy something at a future date at a lesser price. You can get into a contract today and you can try to reduce your risk. So derivatives actually play an important role in risk management. The entire world of risk management is turning around the world of derivatives itself, and they also make the market prices very effective. The reason being, let's say today something is available at 1000 rupees, but in the futures market it is available at 1100 rupees. It means there is a thought process among minds of lot of people that the prices are going to go up in future, because they are ready to buy it at 1100 after 1 month. Today they are not buying it at 1000, but they are ready to buy it at 1100 after 1 month, which means there is a big, I mean, lot of people are thinking that the prices will go up in the next 1 month. Probably they may cross even 1100 also. That's the reason they are ready to buy it even at 1100 after 1 month. So depending on the comparison with the spot market and the futures market, people can actually decide, or probably they can make out whether the prices are going to go up or go down in the future. That is what we are saying. Derivatives play an important role in deciding the efficiency of the market also. And we will see later that they reduce the transaction cost. The reason being, with the in margin trading we were depositing some small money only and trading on a bigger one. In derivatives even more it becomes smaller. So because of that, if the gain comes, it's a jackpot. If the loss comes, it's a loss on the equal side. So unless you plan out your derivatives, so transaction cost wise, they reduce your transaction costs drastically. But at the same time, the gain could be enormous, loss also could be enormous. That is where we say criticism wise, if they are not used properly. If you invest in the derivatives market without proper analysis or evaluation of the derivative securities or derivative contracts, it may result in a huge loss. So if you generally get into a hedging, which is mitigating of your risk purpose, if you are using derivatives, they are very powerful. But if you get into the derivatives market with an intention of speculation, then it's as good as investing your money in a stock market. In a stock market, probably your losses may not be that heavy. Whereas in derivatives market, because of very small margins, the gains or losses could be very much drastic. So that's where sometimes it has also been said that the derivatives are, in some countries, they have also been termed as legalized gambling exercises. The investing in the derivatives market has also been termed as a legalized gambling kind of stuff because of the same reason. If you gain, you will gain a bigger amount. If you lose, you will lose even a bigger amount itself. So that is where in derivatives, there is a huge possibility of making an arbitrage profit. Arbitrage profit we have discussed earlier also, which is a more of making a riskless profit. What is that riskless profit? Without, earning more than risk-free rate of return without taking any risk. If I am taking zero risk, then I should get only risk-free rate of return. But if I am getting more than risk-free rate of return, that excess return which I am getting is called as a risk-free profit, which is also called as arbitrage. Generally, people get in, even in equity we have seen, the arbitrage is a mechanism where people try to find out the mispricing between the two markets. Arbitragers are those kind of people. People try to, let's say BSC, it is traded at some price, NSE it is traded at some price. They'll try to find out if there is a mispricing here and try to take an advantage, buy here, sell here kind of a concept. The same thing comes very heavily in a derivatives market. That particular, as I said, 1000 is in the spot market but 1100 in the futures market. People can really create a profit opportunity by probably buying in the spot market, selling in the futures market, right, and try to make a significant profit also. So those are the various things where we are talking of arbitragers playing a very important role, because see, it's the same asset. Today it is 1000, after 1 month we are talking of 1100. So probably if I wait for 1 month, if I am getting 100 rupees or 10% profit, right, 1000 is becoming 1100, both are sure shot. If I get into a spot market, immediately go to the market and buy it, I have to pay $1000 and buy. After 1 month, because it is available at 1100 in the futures market, I'll enter as a seller in the futures market, which means because I have already bought it, I can sell it at 1000 sure shot at that point. So within 1 month, I am getting $100, and which means it's a non-risky profit itself, because within 1 month, the risk-free profit should be hardly $20 or $30, but I'm making $1000. So because of this reason, the arbitrage plays a very crucial role when it comes to the derivatives market, because it's more of identifying the mispricing in among the securities, among the various types of securities, and planning the transactions accordingly. All right.